Nokia currently serves as the physical backbone of the global AI supercycle, manufacturing the high-capacity fiber optics that connect modern data centers. Training and running modern artificial intelligence models requires moving massive, terabyte-scale datasets across servers in milliseconds. The entire tech industry is facing a shortage of the advanced connectivity hardware required to handle this volume of traffic. To capture this demand, Nokia restructured its operations on January 1, 2026. They created a dedicated network infrastructure segment, specifically designed to supply telecommunications providers and data center operators. Management designed this corporate pivot to align the company's resources with the surge in infrastructure spending triggered by the AI supercycle. The companies building the physical data roads for AI are becoming just as critical to the ecosystem as the software companies programming the models themselves. Nokia's Q2 2026 top-line net sales grew 9% year-over-year. Within network infrastructure, growth reached 12%, while optical networks spiked 20%. However, sales to AI and cloud customers saw the most significant growth, surging by 105%. That demand resulted in a €2.8 billion order intake for AI and cloud infrastructure during the second quarter alone. Rather than a steady trend, these figures suggest a period of rapid, high-volume procurement as customers secure the optical hardware necessary for AI clusters. This starkly divides profitability. While Nokia's comparable operating margin remains steady at 9%, reported operating margin dropped to -1%. This discrepancy results from €800 million in accelerated restructuring charges to aggressively simplify its global footprint. Nokia is allocating €350 million to integrate its joint venture in China and another €200 million to consolidate operations primarily across Europe. Between these restructuring costs and the working capital required to fulfill new orders, Nokia's quarterly free cash flow fell to -€732 million. To maintain liquidity, the company issued a €500 million Eurobond at a 3.625% interest rate. They used these proceeds to refinance older debt maturing in 2028, extending their repayment timeline. The explosive growth in AI sales is currently taking place alongside a costly and large-scale reorganization of the company's internal operations. A severe supply constraint currently limits the global telecommunications and cloud sectors, making hardware difficult to procure. This bottleneck is prompting customers to place long-term orders well in advance to ensure they have the necessary capacity for future expansion. Nokia expects approximately half of the €2.8 billion in AI and cloud orders to convert into revenue over the next 12 months. These external supply chain limitations are effectively creating a predictable revenue runway for Nokia's infrastructure business through the coming year. To sharpen its focus on high-growth areas, Nokia reclassified several non-core units into a portfolio businesses segment, designating them as discontinued operations. While this strategy resulted in a quarter with 0 reported earnings per share, it effectively isolates the company's core research and development as they target leadership in AI-native networks and 6G. Despite the aggressive pace of these changes, Nokia's full-year outlook for comparable operating profit remains unchanged at €2.1 to €2.6 billion. By absorbing these significant costs now, Nokia is prioritizing the long-term positioning of its hardware within the next generation of AI cloud infrastructure over its immediate reported margins.